there are four Greeks, right? Delta, gamma, theta, and vega. The very important one that we make sure we understand is delta, and I think theta is also very important. But the other two we will touch on. But delta and theta are ones that we really want to have a good grasp of after tonight's session. So let's talk about delta first. So in this example, well, let's just list the definition first. Delta measures how sensitive an option is to a $1 change in the price of the underlying. It's expressed on a scale from 0.0 to 1.0. So when the stock price moves $1 up or down with all other things held constant, the delta tells us how much the option value is going to change by. Very simple when you trade, buy and sell stock. You buy 100 shares of stock, if it goes up $1, you made $100. If it goes down $1, you would lose $100. Options are a little different. So you buy an option. The stock's trading at $64 a share. And the option is $4.15. It has a delta of 55. So in this example, we just want to know, okay, well, if the stock goes up from 64 to 65, what impact does that have on the value of my option? Well, with a delta of 55, and we know the stock price went up $1, all other things held constant, the value of the option should also go up by the delta, the 55 cents right there. So the value of the option should now be $4.70. We just add the delta to the premium. Now, the delta will also change based on the stock price as well. That's something else we're going to cover in just a minute here, but I just do want to do another slide about delta before we get into that. So hopefully this makes sense. All other things held constant. When the stock price goes up or down by $1, the value of the option should change by the delta. Delta can also be used as a proxy to estimate the likelihood that an option will expire in the money. All right. So probability of expiring in the money. If a delta has a 40.4, it is a 40% chance it will expire in the money. Now, on this slide in the lower left-hand corner here, I have an option chain listed here. We're only looking at the calls right now, but you'll notice that we've got the strikes up and down the middle of the screen. And then to the left of there, where we have the price action, we have the bid and ask. We're always going to have the bid and ask. We can never remove that. Now, to the left of there, we have, I've loaded delta and prob in the money, probability ITM. All right. And so you notice here, the two columns here, now they're not exact, but that's why I say this can be just used as a proxy. Now, the probability in the money is another proprietary formula trying to determine what the probability that option is going to be in the money at expiration. Now, keep in mind, these options, the screenshot I have here, have 43 days left till expiration. But you can see, for instance, the 130s, the 130 strike options have a delta of 0.46 and a probability in the money of just under 43%. So again, not exact, but very close. And you go up and down the list there, you'll see them all very similar to each other. So like I was saying with the delta, when the stock price goes up by $1, the delta is also going to change. The delta is a dynamic number and it's going to fluctuate. And that's gamma. Gamma measures how much the delta may change with each $1 move of the underlying. All right, so we have in this situation an option of $2.45. That's the premium. The stock's trading at $30 a share. The delta is 0.25. The gamma is 0.05. All right, in this example, if the stock goes up by $1 from 30 to 31, first of all, what does that do to our premium? What's the new value of this option? It should be 245 plus 25. There it is, 270. What's the new delta for this option? It should be 0.25 plus 0.05. Should be 30. The gamma itself really doesn't change that much unless the stock price really significantly fluctuates, but the gamma is going to stay around 5 cents there. All right, so that's the gamma. Now, gamma is kind of interesting because we were just coming off of this extreme move in some of these options of these meme stocks like GameStop, that was an AMC that happened earlier in this year. And people were kind of talking about what was the reason, what was driving the value of these options and the move in the underlying stock price. And there's a theory about gamma squeeze. We're not ready for this lesson yet, but the world's attention was kind of turned to the financial markets, talking about GameStop and AMC, and it had to do with this premise that we're learning right now, the gamma squeeze of these options, just what market makers had to do to hedge themselves from selling options and buying options. Like I said, we don't need to know that. We are not market makers. We're not professional traders or retail traders. We need to have just a general idea of how options are priced. Theta, very fun one. Theta is time decay. It measures the option's sensitivity to the passage of time. So what theta says is basically, as one day goes by, again, all other things held constant, what does the value of my option do? Well, theta is expressed as a positive number, but it's negative. As time goes by, the value of an option erodes by the theta each day. So this isn't my favorite slide, but we go from left to right. We start with a premium of $1.20. An option, the value of $1.20, and it's 20 days left till expiration. That's what that DTE stands for, days till expiration. And the theta is 2 cents. So as 5 days go by, so you see we go from 20 days to 15 days to expiration. So 5 days passed. If the theta is 2 cents, that should be 10 cents that comes out of the value of the option. And that's why the second one right there is $1.10. Theta is still 2 cents. We go from 15 days to 10 days. So again, another 10 cents comes out. Again, all other things held constant. The value of our option is now $1. As we get closer to expiration, the theta increases. So no longer is it 2 cents, it's now 4 cents. Again, another 5 days go by, but 4 cents came out each day. So it's 20 cents of premium. The option is now worth 80 cents. And the last week here, our theta has increased to now 6 cents, and 5 days goes by. And so 5 days times 6, of course, is 30 cents. Our option is now worth 50 cents. So in the span of 20 days, and again, this is a hypothetical situation where nothing else changed, the value of the stock and the volatility, interest rates, nothing else changed. Time just passed. 20 days went by. An option had a value of $1.20, and it got eroded down to 50 cents. That's how theta works. And here's a slide to help us look at this here. So we have two option chains here. It's for the same underlying stock. I think I probably chose Apple. I'm not sure. It doesn't really matter what it is here, but I chose two different expirations. One has 134 days left to expiration. That's on the left-hand side here. That's the August options we see there. And then the one on the right here is the one, actually they expired on Friday. I was creating this deck last week here. So it was 1 day left to expiration. But I want to draw your attention to here in particular is just the 130 strike calls. Sorry, yes, 130 strike calls. So with 134 days left to go, these are trading for around $8.30. And look at the theta, it's 0.03. So it's saying as 1 day goes by, all other things held constant, the value of this option gets eroded by 3 cents. 3 cents gets taken out of the value of this option, theoretically. When we just had basically 2 days left, 1 day left till expiration, that's the one on the right now. Take a look at that highlight there in red. The same option, the 130 strike, is worth around 19.5 cents, call it 20 cents. Look at the theta on this one, 0.15. 15 cents per day are getting taken out of this option just with time decay. And that should make sense here because look, it's trading for around 20 cents, but it's out of the money. It's not in that purple shaded region. It's an out of the money option. So if nothing else changes, if the stock price doesn't come up, this option is going to go to zero. So theta, time value, is going to be the one that takes it there. All right, moving on to Vega. So Vega measures an option sensitivity to changes in the volatility of the underlying asset. So on the left-hand side here, I just have some sample stocks in the Dow Jones Industrial Average. These are just random implied volatilities that I have for each one of these stocks. Now, what it says here is with a 1% change in volatility, what will the options value change by? And Vega attempts to approximate that amount. For an example here, all right, an Apple call has a value of $2 and its Vega is 0.65. If the implied volatility increases from where it's at now, 30.30 to 31.30, the options value should increase to 265, all other things held constant. Volatility. Now, volatility can be an important factor that we need to be aware of specifically right now because we're entering earnings season. So when you have an earnings announcement coming up, volatility is going to be at its greatest. Typically, it's going to be at its greatest before all four earnings throughout the year. All right, so we can see I have in this calendar right here on Monday before earnings, volatility is cranked up. Earnings announcement comes out on Wednesday. On Thursday, it significantly gets reduced there. All right, so all the value that's in the option based on the volatility, when the unknown becomes known, that option premium, that value that was in there gets taken out. Just something to be aware of. All right, considerations when buying options. I'm glad we did this 2 weeks ago. We bought an option and we sold an option. So some things to think about for our checklist when we did those trades. If you remember, we bought Intel and sold Baidu. But let's just talk about buying options. How far do we expect the stock to go? This should impact your strike price choice. All right, so if we think the stock is only going to go up just a little bit, we would likely buy a deeper in the money option. Now, we would be risking more, but the deeper in the money options are going to appreciate in value relative to the stock price at a higher rate. If you buy an out of the money option and the stock only just goes up a little bit, the problem is by expiration, your option might not even be in the money. Even if it is, it might be a little bit in the money. But you paid a lot for that option because there was time value and maybe a little volatility in there. So how far do we expect the stock to go? It's going to significantly impact the strike that we choose. How long do we think it will take to get there? Of course, time decay works against buyers. The longer that we hold an option, the more premium gets sucked out just on time alone. Is volatility working in my favor? Relatively low volatility is favorable for options buyers. So if I'm buying options, I want to make sure that the volatility in the stock is not that high, because when volatility increases, so does the value of the option. If volatility decreases, the value of the option also decreases. And do I have a plan? What are my entry, exits, and position sizing? We'll talk a little bit about that a little bit later. Considerations when selling options. Now, I'm not going to go through this one in detail because it's basically the inverse kind of what we were just talking about, except for where we expect the stock to go. But time decay works favorably for us. So we receive a lot of premium the further out the option is, and less so as it gets closer to expiration. Volatility. It's considered favorable to sell options in a high volatility environment. So we talk a lot about generating income with options. How do you do that? Well, it's basically selling options to generate income through premium. So we sell an option, receive that premium, and the goal is for the option, whether it's a call or a put, to depreciate to zero. And we get to keep that premium. So the pro is we collect premium. The con for this, of course, is that there are many risks involved. Well, one of them is assignment risk. Regardless if we sell a call or a put, we could get assigned and have to make good on that option agreement. We'll be obligated to buy or sell the underlying if the option is exercised. And that's it. That's the Greeks. A quick crash course on Greeks.